Good afternoon and welcome to this week's edition of the Elite Traders Club Education Session. The topic for this week is market cycles. In particular, the reason for having a look at this is over the last few weeks in particular with rising market volatility, very curious to see whether or not there is anything in the past when there's been times of increased volatility, any clues as to whether or not we might be experiencing some change in overall market dynamics, particularly in the US. It's been, for a number of years, a fairly sort of low volatile market up until recent times. And certainly the beginning of September, we saw during one session a 1,000-point drop on the Dow. So is there anything behind these types of moves at the moment? Are they consistent with previous historical patterns in the market? I think it's interesting to go back and see if there's any lessons that we might be able to learn from history. So let's get underway. The agenda for today is to have a look and see if we can make any observations about what's happening in the market at the moment. Are there any parallels previously at any points in history that are worth observing? Going to be having a look at some longer term trends, and in that respect looking at some monthly charts. Looking to see if there are any lessons from the past, given that the market is made up of, at the end of the day, a whole lot of humans interacting, whether they're retail investors or whether they are active participants in the larger funds, etc. What sort of patterns of behaviour potentially exhibit and on themselves on a chart that we might be able to interpret, and also having a little bit of a look at the current market risk indicators and see what they're saying. All right, so with that as the backdrop, the disclaimer, of course, the content of this presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your investment objectives, your financial situations, nor particular needs. So before making an investing decision based on the general advice presented in any of our presentations, please consider whether the advice is appropriate in light of your financial circumstances. All right, so let's get things underway. All right, market cycles. What are market cycles and what can we learn from them? It's quite apparent when we have a look at Beyond Charts or any trading platform charting package, that is, when you look at a broad set of data over a long time frame, particularly looking at monthly charts, you become aware of particular patterns. And it's interesting that these patterns seem to occur in fairly sort of regular time frames. In fact, we'll have a look at this in a moment. Every 6.5 to 7 years, it appears, give or take, 3 or 4 months either side, that something seems to happen in the market. Now, whether or not they're inflection points, what the time frame has got to do with it, I'm not too sure. But certainly, there's some very powerful observations can be drawn, and I think it's interesting not to ignore lessons of the past and just acknowledge where we are now and what that might mean for future activity in the market. So let's expand on that a little bit. I'm going to bring up Beyond Charts, and what I'm going to do here is I'm just going to zoom out a little bit, and you'll see on the chart here, this is a monthly chart that all the way back to even 1987, those of you who are in the markets in 1987 would remember, I think it was Black Monday or Black Tuesday. Everything seems to be black, black swan events, etc. in the market. During that particular time, and you'll see that evidence through here, this big sell-off in October of 87. So we certainly had a fairly significant market move down, and at that time, that was very, very significant. And those of you who are in the market around that period would have experienced all that. It was right throughout the news, massive headlines, etc. along the way. Fast forward around about another 6.5 to 7 years towards the end of sort of 1993. Our market really didn't have the same sort of sell-off during that particular time, but by the same token, our market really stopped sort of going up to any extent and just drifted sideways for about the next 12 months thereabouts. Then we had this fantastic bull market, in the late 90s, etc., particularly in the US. It was a very, very strong market on the back of the Nasdaq, etc. And then the market topped out, again, not surprisingly, around about 6 to 7 years later on, before coming off its highs and moving back down. So quite a significant retracement from its high levels around about 6.5 to 7 years later. After bottoming and then turning around and moving up, again, the price moved up very, very strongly, and we reached a peak again, coincidentally, around about 6 to 7 years later on. 6.5 to 7 years later on, we reached another market peak before falling down quite quickly again. So this time, this was the GFC, and I think everyone's got fairly recent memories of that because of the sharp sell-off in not just the American market, but the Australian market as well. Now, since that point in time, the top of the bull market pre-GFC, if we fast forward another 6.5 to 7 years, you'll see where this last line is drawn in. So let's just zoom in a little bit and have a little bit closer look about where we are and what sort of things are happening in our market at the moment. In more recent times, you might remember towards the end of last year, we had a big sell-off in, I think it was November, potentially October, 31st of October. So through the month of October, we actually had mid-month a huge black candle on the index, and it was looking very bearish indeed, only to find some support and move back up. And since then, we've also had, in fact, last month, a big sell-off in the index. So we've had two quite extreme sell-offs in the last sort of in the last year. So have they occurred before when we've been around 6 to 7 years from previous market highs? Well, let's go back to the previous market high just prior to the GFC. So I'll go back in time a little bit and see if there's anything at that particular time where we had some big market sell-offs before the rest of the market moved over. So getting up towards our market highs, we never know that we're at a market high until afterwards, obviously, but there were certainly some signals that perhaps the market was starting to wonder how long this was going to continue for. We had a little bit of a sell-off through this particular period in here, and again, that was at the beginning of 2007. We had a much more significant sell-off later in the year, so that was in August of that year, and then we had another big sell-off in November, and then we had another big sell-off in January of 2008. Now, that was prior to all the carnage that was the GFC. So we had a couple of opportunities here where the market was actually testing lows a number of times before falling out of bed. Let's go back another 6.5 to 7 years and see what sort of things were occurring in the market at that time. Again, as the market was moving up, sort of mid-cycle, it appears, we had a bit of a sell-off. But then the market rebounded very, very quickly, as it can often do in a broad-based bull market. Moved back to the upside, and before topping out and moving to the downward sign, were there any signals, if you like, where the market was starting to struggle? Well, certainly we started to have a number of retracements that are getting a little bit closer together, a little bit more frequently, if you like, compared to the sort of broader-based upward moves prior. Other than that, a little bit of a retracement coming through before we topped out, and then certainly after we topped out, market coming back down, trying to push up, couldn't, and then falling away. So perhaps there's a little bit in some of this price action that's occurring. Go back another 6.5 to 7 years, 1993 was around about that sort of time. What really happened in the market then? It was a much calmer type of price action movement in the lead up to sort of that 6 to 7 year period before the market really drifted sideways for a period of time. So certainly not a significant downward move by any stretch of the imagination at all there. So lessons from that, couldn't really draw much in the way of or learn much from that particular price action there. Previous up to 1987, the big Black Tuesday event, I think it was in Australia at the time. Big sell-off there. Any clues that we might be in for a tough time there? Well, in terms of retracements, etc., certainly nothing significant at that point in time that we could learn from previous history. Okay, so what do we draw from that at the moment? Is there anything that's making us think where we are at the moment? You know, is it more like 2000? Is it more like 2007? Or maybe is it more like 1993? I think we need to look at a little bit more evidence. So what I'm going to do now is I'm just going to go up to my favourites here and I'm going to put on a moving average. Now it says 8 period, I'm just going to change that. We're on a monthly chart. I'm just putting on a 10 period moving average. So let's go back in time a little bit and have a look at some of the more significant swings in our market. Let's just zoom in a little bit, and what I might do as well, just so you can see peaks and troughs along the way, is let's put on our swing chart. So this was back in 2000 after we'd had that nice move, very nice move up over a period of time. And certainly as the market started to top out, now we can only see it topping out, in a historical context, in that we know where the top is. But some of the characteristics of this particular market I think are interesting. We started to have these quite big swings to the downward side, so a number of troughs coming back. And then eventually what we had, and I think this is really significant, is a close below its monthly moving average, which is always a very bearish signal. So from that point, it's a matter of, can the market recover once the market closes below that 10-month moving average? Now, on the way up, we had a close below the 10-month moving average, but the next 2 months, price rallied very, very strongly, closing back above that and continued to rally up very, very strongly. So that was obviously a good recovery. The market wasn't ready to capitulate and fall over. The next time when we got that close below the 10-month moving average, what happened with price then? Well, it continued to fall down, and it tried to rally back up, but it couldn't close back above what now appears to be a level of dynamic resistance, if you like. And the market really didn't get any traction for probably a number of months, from all the way through effectively the date there from November 2000 all the way through until we closed back above it, well, really in 2003, in April, January, February, March, April of 2003. So a significant period there where the index was below that its longer term 10-month moving average. So interesting to see what price did once it closed below that longer term moving average. What happened in 2007? Well, again, as we started to get towards the top, and we don't know we're at the top until afterwards, we started to get a couple of swings towards the downward side, and particularly these troughs coming down at the same sorts of level. Now, if there was lots of demand in the market at that time, the troughs should have been certainly higher. And look, it might be marginally higher there. We won't worry about that too much. But the important thing is, what happens when price starts to close below our 10-month moving average? Well, there's a close, the first close below that 10-month moving average there. And if I can hold the cursor still on that line, let's put on the value line, and that'll give us a proper date. When it closed below was New Year's Eve 2007 was the first time that price closed below the 10-period moving average. So let me just move that out of the way for the time being, and let's just focus in a little bit on what happened with price after it closed below that moving average. Closed below the moving average and tried to rally back up, and the same thing happened as happened back in 2000. Price tried to rally back up, it couldn't, and from that point onwards, price moved down, and never ever again did it move back above that moving average. So the way that price was behaving could certainly tell us that this market was undergoing some transition from a bull side market into a bearish side market, if you like, or a demand side market into a supply side. Interestingly, if we move fast forward another sort of 6.5 to 7 years, thereabouts, we get up into 2014 territory, which is where that line is there at the moment. Now, obviously, all through this period, we've had some quantitative easing in the States, a number of different measures to try and breathe life back into the economy over there. In fact, we've had quantitative easing in lots of countries around the world. Interesting on the way up, if we just observe what's happened with how price has behaved whenever we've had a close below our longer term moving average. Whenever we've had a close on the way up, it hasn't taken too much of market effort to get back above that moving average. A close below here, certainly during the, if you remember back to the Eurozone crisis in particular, things were pretty dire through there for a few months. And then price rallied quite strongly, closed above our moving average. And then we had 1 month, about 6 months later on, where we had a close below. And then since then, from 2012, middle of 2012, price has remained above that 10-month moving average for quite a significant period of time. The important thing here to realise is not whether price is closing above or below, but more how price is reacting when we get down below that 10-month moving average. So we've had quite a sharp sell-off back in, we were talking October last year, before price rallying, started to move up, and then we had a number of candles at the top here, all with shadows, the bodies, if you like, within each of those candles, starting to be quite small, and then throughout August we had certainly a much more negative month and a move down to the lower end. So price is now closed below our longer term moving average. So what we need to be mindful of here is how is price now going to respond. If there's any lessons from the past, what we'd be looking to see is price trying to rally back up to the 10-period moving average, which on the last several occasions, once we had a close below, we saw price try to rally back up and fail before capitulating. The time before, once price had closed below our 10-month moving average, what happens with price? What happens with price action? It fell down, it tried to move back to the upward side. Even in the middle there's a white candle where price tried to move back up. It couldn't. It got pushed down, and then for the next 10 to 12 months, in fact, a couple of years, price kept going further and further down. So it's really important, I think, at this stage to see what happens with price at this point, whether it can rally back up towards our longer term moving average. If it can close above it and continue moving upwards, then I think that's a very positive sign. I'm not convinced that that's going to happen at this stage. I'm really keen to see what's going to happen with price throughout the remainder of September to see whether they can actually rally back up to the moving average, and from there whether or not it can close above or whether it gets knocked on the head and pushed further to the downward side. So I think that makes sense to think about what's happened in the markets previously, not to predict what's going to happen, but just to be an observer and respecting some of the lessons from the past. So interesting to have a look at some of those concepts. The longer term trend, so looking at a 10-period exponential moving average on a monthly chart. And you can do that on your own beyond charts at home. We've had a bit of a look at how price has reacted in the past. What should we be looking for? Well, certainly we should be looking for, now that price is closed below that longer term moving average, we should be looking to see whether or not we can rally back up to that level, retest it, whether we can close above it, or whether in fact we try and retest, we fail, and the market starts to move to the downward side. That would be a particularly bearish move for the market, and I think the whole sentiment would change completely. Against that as the backdrop, we've got market risk indicators. Why do we have them? Well, very importantly, and I hope you can answer this question yourself, we have them to help us manage our risk across our portfolio. So at the moment, what are they saying? Well, let's go back and have a look. So let's put them on the market at the moment. So if we go to the S&P 1500, that's our benchmark index at the moment. The reason I use the S&P 500 was that we can go back in time much further to see what's happened during different market cycles. It's a bit difficult on the S&P 1500 because its history is not as long, but this is our benchmark indicator. The two basically mirror each other in any case. So let's go through and just put on our market risk indicator there. And at this point in time, let's just zoom in a little bit from the beginning of the year. At the moment, from the 1st of January thereabouts to now, the S&P 1500 is down around about 5% for getting close to a year. So if it keeps going at that rate, we're going to be down nearly 7.75% at that particular rate. I'll just take that off for the time being. But important to note, and we've discussed this quite a bit throughout the last few months, is that we certainly had price moving sideways for a long period of time, and our market risk indicator started to move to the downward side. So when price is going sideways and our momentum indicator is moving to the downward side, that's what's called divergence. So it wasn't a huge surprise that all of a sudden, when price couldn't make any further upward movement and momentum was really waning, that the whole strength, if you like, the whole stability of this trading range was eroded and the market fell out of bed very, very quickly. Now, the key aspect of this is this stochastic going below 60, which really starts to move us into high-risk territory. Now, that moved into high-risk territory before this market fell out of bed. Okay, so that's always something to be mindful of, and I've said it many, many times, that once we get down to 60, the propensity for a market to fall away to the downward side increases significantly. It's done that. Now, at this point in time, the other green line on here is a 200-period exponential moving average. That's effectively the same as a 10-month moving average on a monthly chart. That is 200 periods of data, 200 days. A 40-week is exactly the same indicator as well. Now, how is price behaving in terms of this? Well, price is clearly well below that now. It's going back up and it's trying to test that level once again. We've seen these last three candles. It's a classic 3-bar reversal at this stage. It's particularly bearish given that we've broken down and we're going back up to retest. This market has got a lot of work to do. Excuse me, a lot of work to do to get the confidence back in and start closing back above this longer term moving average. Let's just go back in time a little bit and see how it's behaved before. On previous occasions where the market has come down below its moving average, it's responded very, very quickly. And this is typical of sort of shorter term corrections in a broader based bull market. So a number of opportunities where markets have declined, moving down towards the longer term moving average before accelerating away once again. And in those type of situations where the market's less volatile, those sorts of opportunities are opportunities for the big fund managers, etc., along the way to use those opportunities to add to their portfolios. So you'll see a number of opportunities where markets, have dipped below sort of low risk, more into moderate, coming down to a longer term moving average and responding accordingly. When was the last time that we really sort of fell through and struggled to get back up? There's another another retracement where the bigger fish out there, the fund managers, etc., use it as an opportunity to refill or top up portfolios along the way. And again, same down in this particular area as well. Significantly, when we last spent time before the longer term moving average was during the Eurozone crisis. Price closed below. We tried to rally back up a couple of times and we couldn't. And our market, not just the US market, but the Australian market as well, took a long time to recover and start moving to the upward side again. Prior to that, other times when we were significantly below, during periods of 2010, once we closed below, we rallied back up and fell out again, and we had a broad sideways ranging market for a period of time. Prior to that, we've got to go all the way back to the GFC, where price spent a long time below that longer term moving average. In fact, all-time highs back in, I think it was November at that particular time in the Australian market that was. And as you can see, price coming back down, rallying back up towards the longer-term moving average. You'll notice at this point that the moving average is quite flat, trying to rally back up, and every time it tried to get back up, price was rejected at those particular levels all the way along. So very interesting, and from a simple point of view, that moving average is a very good guide in terms of overall market sentiment. When the market's above it, we're in a bullish mode. Certainly things have changed in more recent times, whether it's China, whether it's the Fed. A fair bit of uncertainty out there at the moment, and it just pays to be quite mindful, respecting the market risk model. It's there to protect your capital, so make sure that you're giving it all the and due diligence, etc., and respect that it absolutely deserves. So I'll just jump back into the last slide for today's session. Your market risk indicators, please follow them. It's telling you what level the market risk is at for the particular time. So when you think about it and you're taking positions in the market, you are actually buying risk. Okay, so when you're exchanging the security of cash, you are taking on the risk of the stock because you believe that it has the potential to provide a specific return. Looking at the market risk indicators, they're telling us at the moment that we're in a higher risk market. The behaviour of the markets are appearing more risky, more in alignment with some of the previous corrections and significant corrections that we've had. Am I forecasting it? No, not at this stage. I'm waiting to see what price is going to do now that we've closed below that longer term moving average. But really important, I think, to keep your mind firmly focused on capital risk management. You should be well positioned in case the market does happen to move away even more to the downward side. So certainly if you've been stopped out of positions, I wouldn't be focused on adding any positions at this point in time. You've got limits for your value at risk at this junction, so certainly abide by that. So focus on your risk management and your portfolio management in particular. Well, that's it, folks. I hope you've learnt something from those observations today. It's interesting to see whether history repeats itself or not. But importantly, keep an eye on that price action. What happens when price rallies back towards that longer term moving average? I think that's an important inflection point in our market. If we close back above it strongly, then I think that gives us a little bit of confidence that there might be some room left in this market to the upward side. But if it doesn't and fails, then I think we might be in for certainly a rough ride to the downward side. All right, folks, thanks for watching, and we'll catch up with you again shortly. Bye for now.